So insurance salesmen give you useless anecdotes, deceptive shell games, and straw man arguments. I give you spreadsheets. Now there's these newer annuities out there that sound too good to be true. In the first 10 years, they're going to pay you a simple 10% growth rate, which is actually a 7.2% annual compounding growth rate. Basically, your money doubles in 10 years. Well, I'm here to tell you that number one, this is too good to be true because this is not money that doubles and then after 10 years you can just cash out and be on your way. Doesn't work that way. This money is merely what they call a benefit base or income base or accumulation value, or they might call it a roll-up rate. This money is merely an accounting ledger or a basis for determining an income payment rate when you annuitize the contract, which means after typically 10 years, you begin receiving what are fixed income payments for life that are based on the value of that benefit base. And then number two, we get into the question of what's going to be the percentage of the benefit base that I get. Is it going to be 3% per year? Is it going to be 4%, 5%, 6%? Well, I found a blog on Annuity123.com, and this guy's talking about 5% being the rate for someone who buys one of these annuities at age 55 and then starts the income spigot 10 years later at age 65. But so let's stop it right there. Does this sound like a good deal to you? After 10 years, your $100,000 doubles to about $200,000. Then you start receiving fixed income payments of 5% or $10,000 a year every year for as long as you live. Does this sound like a good deal to you? Well, I'm going to show you why this is a horrible deal, even compared to a super low-risk portfolio of stock and bond index funds starting at the worst year in history to retire, 1966 onward, when we had rising interest rates, just like people are fearing right now, and poor investment returns, just like these doom and gloomers are fearing right now. And don't forget to keep this in mind as I show you this. I'm picking the worst starting point in history. I'm trying really hard to make the annuity look good by picking a worst case scenario for bonds and stocks. So first of all, one of the glaring downsides about index annuities is that once you enter the distribution phase, once you turn on the income spigot and annuitize the contract, the growth of your money stops. Imagine if your portfolio of stocks and bonds, well, hopefully you own index funds, but imagine if once you entered retirement, your bonds stopped growing in value and the stock market just became frozen in time. You know, the Dow Jones Industrial Average just got stuck at, right now, 18,300 for the rest of your life. You would be pretty ticked off. Then at that point, as you're spending down that money in retirement, and of course your account value, since it's not growing, just drops and drops and drops. Well, guess what? That's exactly how these index annuities work. And that's why insurance companies are laughing all the way to the bank when they sell you these things. So here we go, side by side. On the left side, our 55-year-old dumps his money into an index annuity. By age 65, he's got this benefit base of $200,000. Then he starts getting $10,000 income payments once a year, every year for as long as he lives. Notice by age 84, the annuity has already paid out the amount of the benefit base, and therefore, at this point in time, his beneficiaries will inherit nothing. Zero, zippo, nada. And actually, most people elect to get these guaranteed income riders, which subtract as much as 1.3% per year from the benefit base. So in reality, by about age 81 or 82, there will be nothing left for his heirs. But so what's happening over here with our stock bond index fund portfolio? Notice by age 65, it has only grown to $146,000, and our income payments are only $5,876 in year one when he's 65 years old. But by age 71, after we've been increasing those 4% income payments with inflation, we've now equaled what the annuity is paying, and he's got $144,000 in equity to his name. By age 80, we're taking out $4,450 more than what the annuity is paying, and we've got $306,000 worth of equity going to work for him, and it's available for his heirs to inherit if he were to drop dead at age 80. Meanwhile, the annuity only has about $30 to $40,000 left as a death benefit value at age 80. And as he gets older, his financial situation just keeps getting worse and worse. Pretty soon, his heirs get nothing. And those paltry $10,000 fixed income payments for life that you can never outlive have left him in poverty because they don't keep up with inflation. So what have we learned? Index annuities are smoke and mirrors. They guarantee for you basically a diminished lifestyle. And again, don't forget that I picked a starting point that was the worst year to retire. And from this point onward, the annuity still got slaughtered. What else have we learned? Insurance salesmen are deceptive, sneaky clowns. They always try to take your eye off the ball with their shell game. They'll say, look over here, your money doubles in 10 years, without telling you about what happens afterwards. Or if they do, they'll say that you get income payments that exceed what you would otherwise get with stocks and bonds. And of course, they're cherry picking, talking about that initial period and not talking about what happens later.